Good morning, everybody. I'm Ed Parcaut. That's right. Real Estate Jerky Daily time. Mike Kelly's not here today. He's under the weather. When you get older, you have those issues. Actually, I was sick last week. Not majorly sick, but just had that crud that's been going around. So let's get right into it because you know how I am. I'm very direct, and let's get right to the point. All right, we've haven't been here for 2 weeks. A lot of stuff still happened during those 2 weeks. A lot of contracts, a lot of other stuff. Let's see what's going on right now in the market today. Let me get over here because I haven't updated this yet. Get over there. All right. So as of right now, mortgage-backed securities are up 2 basis points, and the 10-year is sitting at 4.61. Now, I want to remind everybody, back in September, we were 3.61. So we went up 100 basis points since then, and that's why rates are a lot higher than we were before. Is that stopping people? No. Everybody thinking it's a much better time with everything that's changing. In about 14 days, we'll have the actual new president in, and all these young kids are on social media will stop saying, well, Trump's been elected since now, and he's done nothing, and Biden's done so much more. He's not president yet. Anyway, let's get to the market. All right. So this week, Treasury is issuing 119 billion in new debt, which includes 39 billion in 10-year notes and 22 billion in 30-year bonds. You're probably saying, why do I care, Ed? Well, the increase in Treasury supply will affect demand and can have an effect and the demand at the auction. I can't get these words out today. Will impact bond prices and yields. Lower demand for treasuries will push yields higher, which means mortgage rates will go up. So this is not good for us, but this stuff is going to happen. And how do we fix it? We'll find out next. We'll find out in about 14 days if there's any way we're going to be able to fix this. Mortgage bonds are testing critical support level right now. Hopefully if this level will fail and it'll make the points go a little bit lower so we can get a little bit better rates, but I'm not holding my breath on that. The Federal Reserve's got a bunch of outgoing presidents and incoming presidents. Uh, I'm not going to go through all of them and all that stuff. We don't have enough time today. Plus, I don't have somebody else to talk to. So, this is going to tilt it more of a dovish tilt, which could affect policy towards easing, depending on the upcoming data. The big takeaway is they're really laser focused on the labor market data. And last week, unemployment numbers came out worse than we expected, and that's why rates went up. So we're really going to focus on this week. This is jobs week. Tuesday, we have JOLTS report, ISM Service Index, and then we're also having that 10-year Treasury auction that we're on Tuesday. Wednesday's mortgage applications, ADP employment report, Fed minutes, and 30-year Treasury auction. That's when those are happening. When I talked about Thursday's initial jobless claims, and Friday is the BLS jobs report. All these jobs is going to really show where we are going forward, and if we're going to see a big difference in the rates. Because if we're not seeing unemployment going up and people losing jobs, it's a better market. We're going to see rates stay here for a while. The only way in this type of a market, if we keep showing that people are buying, people are doing this, people are still employed, all that would be for the government to get involved and actually start buying the bonds. We really don't want to do that. So why don't we just make them tax deductible so the rest of us can buy them and we would do it for them. All right. Want to look at apartment. Actually, I want to get right into inventory. Excuse me. Inventory actually dropped by 15,560 this week, end of last week, went from 650,992 to 635,432. The all-time inventory low was in 2022 of only 240,497 on the market. And the peak for 2024 was 739,000. Huge difference. But if you look at in 2015, we were only 959,000, which is a typical normal market. I keep hearing we have a lot of inventory on the market. I don't see a lot of inventory on the market. Maybe it's regional because I know Texas, Florida, and some of those places where everybody moved to have a lot more houses on the market because I think people are trying to leave. I don't know for a fact because I don't live there and I haven't talked to anybody in the last couple of days about it, but we'll find out more information this week, especially when Mike gets here. Okay, what else? What are we looking at this week? All right, as I said, I'm still dealing with this crud. Key events again that we're watching this week: the Treasury auctions, the labor market, the total change, the tilt of the Fed, more of a dovish tilt. That is going to affect a lot of things going forward. We need to just focus on doing business. What I'm getting at is make sure all your stuff's in place. Make sure your CRMs are up to date. Make sure that you're getting that information out to your clients. Make sure you're contacting your clients, because if you don't, somebody else will. And then you're not going to have those clients. And it's really important to build relationships, build teams, build all that stuff, work together, help each other out. And if you guys need any help at all, let me know. Again, I don't want to focus on. I know we bring the news, we bring certain things, and I focus on a lot of the bonds and what we're going on, where rates are, but people are still buying. And it's still great time to buy. If you can find a house that fits, works for you, buy that house now. We can always. I don't want to get into that date the rate stuff and all that other stuff. I don't want to get into that, but I'm just saying you will eventually be able to refinance and get these rates down. I don't know when, I don't know how much, because none of this stuff has been going the last 2 years the way that we thought it was going to go. None of it. I Well, except for the election, I knew it was going to go that way eventually, because there was so much pain out there with the inflation and all that stuff. Finally, was affecting people. You wouldn't notice by the Christmas time because people bought a lot of stuff during Christmas, but they're getting that little hangover right now saying, "Oh my goodness, I wish I wouldn't have bought all this stuff for Christmas gifts." And it's going to affect them going forward. However, don't focus on all the noise. Just focus on doing work. Focus on helping clients. That's the best thing you can do. And that's pretty much all I have for today. So this week's jobs report, like I said, is going to focus on really tell us where we're going forward. And actually, I think February numbers are going to be the really showing us where we're going forward. Because right now, January usually is, people aren't buying, people aren't doing this because of what happened, after Christmas. But we'll see what happens. Again, Mike will be back tomorrow. Thanks for being here. We really appreciate you. We'll be back. We've been on the radio, but last weekend was only best of, and the weekend before that was best of. So we'll be back live this weekend on the radio also. So everybody, make it a great day. If you have any questions, reach out. And again, thanks for everything you do. And we appreciate you all. Make it a great day. Bye.